It's another Friday in Finance here at Brookstone Financial. And today I want to talk to you about how to get the most out of what you've got in Social Security benefits. Now, a lot of folks don't spend enough time planning for one of the largest financial decisions of their life, and that's when and how to file for Social Security. The objection we often get into talking clients into potentially delaying, at least until full retirement age, is what if I die young? Let me show you a simple break-even analysis when it comes to getting the most out of Social Security benefits. So currently, the earliest age in which you can file for benefits is age 62. Full retirement age for those born between 1943 and 1954 is age 66. Now, you can delay all the way up until age 70 and earn what's called delayed credits. Delayed credits simply mean that your benefit is going to increase by 8% simple interest each and every year. So if we look at these ages, again, 62 being the earliest age in which we can file for benefits, 66 in many cases being full retirement age, and 70 getting the most out of Social Security. Let's look at the break even. So if we file at 62, here's our trajectory. If we file at 66, here is our trajectory. And if we file at age 70, here's our trajectory here. Now, this intersection point right here where all these lines intersect, typically that's going to be around the age of 80 to 81, meaning that if you file early, not only do you surrender some of your benefit, but you probably leave a lot of money on the table if in fact you live beyond the age of 80 or 81. If you file at 70 and you live beyond the age of 80 or 81, if you look at the trajectory of this line, all right, that steep trajectory, you get a lot more out of Social Security. So you don't have to live as long as you may think to get the most out of Social Security by simply delaying your benefit. Now, there's also the discussion of taxation on benefits. A lot of folks say, wait a minute, I've already paid taxes on this money once. I don't want to pay taxes on this money again. Well, first of all, let me tell you that FICA tax is the tax that funds Social Security benefits. And FICA taxes during your working years weren't being taxed. So you really haven't paid taxes on the money twice like a lot of people would think. Now, one of the strategies that we utilize to help people minimize the taxes on Social Security benefits is a Roth conversion strategy. Let me give you an example. Let's say I meet with an individual and their income for the year is $57,000, okay? So $57K is their income for the year. Well, we know that the top of the current 12% federal tax bracket is $77,000. Okay, so to hit the top of the 12% federal tax bracket is $77,000. If they're earning $57,000 in that year, we would probably suggest that they consider converting $20,000 to Roth IRA. Couple reasons why we would do that. The probability that taxes will increase in the future is pretty good. I meet very few people that would lead you to believe that taxes are going to continue to decline in the future. I mean, we have $20+ trillion worth of debt. Someone has to pay at some point. But the reason we start converting to Roth sooner than later is because we want to potentially minimize your required minimum distribution when you reach age 70 and a half. And you may have already heard of what's called RMDs, but when you reach age 70 and a half, Uncle Sam says you have to start taking withdrawals from your IRA or your 401k, whether you actually need the money or not. You have to take that income. Now, what I often see is that because folks are forced into taking that income, that required minimum distribution, it forces a higher level of taxation on their Social Security benefits. One way to reduce that taxation is by reducing the value of your IRA. Now, I'm not saying cash out and get rid of your IRA. I'm just saying start paying the taxes on your IRA sooner than later, because by doing so, the value that's used to calculate that required minimum distribution in the future is much smaller potentially, because your Roth IRA does not come into account for required minimum distributions. It's completely off the radar, and it's also tax-free when you take that money out. A big misconception when it comes to Roth IRAs. Many people will say, well, wait a minute, I'm too old for a Roth IRA. Let me tell you something. You're never too old for a Roth IRA conversion, consultation, or strategy, okay? A lot of folks would say, well, wait a minute, I'm not working anymore. I don't have any earned income, so I can't contribute to an IRA. That may be true, and it is true under contribution rules. But when it comes to conversion rules, anyone can convert. You do not have to have earned income to convert to a Roth IRA. So in most cases, we're talking about conversion strategies with our clients. If you'd like to take advantage of a complimentary consultation, everyone that comes in will receive a copy of my new book, Innovations in Retirement Planning. And this is all about how to get the most out of what you've got. We often talk about a puzzle analogy, and you ask yourself, okay, what's the most important piece of a puzzle? Is it the outside edge, the corner piece, maybe the last piece? It's really the picture on the box. At Brookstone Financial, we provide the picture on the box for your retirement. Give us a call. Our toll-free number is 866-945-3220, or visit us online at brookstonefinancial.com and click the Let's Get Started link in the upper right-hand corner of the page. Thanks, and have a great weekend.